A couple of days ago, a digital lending company posted a message on Twitter telling the public they will not call any of their customers' contacts demanding debt repayment. The message came only days after Citizen Television aired a disturbing feature aptly titled Debt of Shame, highlighting what has now been given a name, debt shaming. This seemingly fancy terminology simply refers to the horror of a debt collector calling you multiple times and harassing you, not because you took a loan, but simply because you're a guarantor for a mobile loan, sometimes without your knowledge. But more disturbingly is if you are just one of the contacts on the phone book of the person who took the loan. In short, your privacy and peace of mind are violated for a loan you probably had no idea about. The debt collector calls you with multiple numbers, hoping that you'll get tired and simply pay to get them off your back. Yes, there are two sides to digital credit. On one hand, it has helped many people access cash quickly. How many times have you urgently needed cash and been able to do it fast with just clicking a few buttons on your mobile phone? And what about those business people who depend on that loan to make purchases and pay back at the end of the day? The digital credit is a godsend for many, providing credit options for consumers at the bottom of the financial pyramid, without the indignity of having to beg friends or family members. They have changed the game. Remember how difficult it used to be to get a loan from a bank? All the documents you had to provide, the collateral, and even with all that, there was no guarantee that you'd get that loan. But this menace called debt shaming is now giving digital credit a bad name, casting a dark shadow on an otherwise noble idea. Yes, digital lending is a risky business. Imagine lending money to someone you have never seen, whose credit worthiness you have never tested. There are those who will take a loan and refuse to pay. Such people change their phone numbers and become unavailable, leaving the lender in a quandary. But is that enough justification to bombard my phone with endless calls, yet I'm not the one who took the loan? Every business has its risk profile, and the lenders usually factor that in when they decide who to give, how to give, and sometimes at how much. It is business. An audit report by FSD Kenya in 2019 showed that there are 110 digital credit providers offering loans of between 1,000 shillings and 16,000 shillings on the first attempt. They use the first loan to gauge the true trustworthiness of an individual before offering further credit. But this new form of credit comes with some rather punitive terms and conditions, and the easy access to the loans could lead to a vicious cycle of borrowing. Still, Kenyans borrowed 1.2 billion shillings daily in 2020 on 2 mobile apps alone, just 2. Clearly, digital lending is not going anywhere anytime soon. That is why we must address these emerging challenges while bearing in mind the immense benefits of these loans. Both the government and the digital lending sector must embark on an aggressive financial literacy campaign to ensure people take loans only when they need it, and that they demand a majority of these loans get used in generating income. But there's another aspect of this that has nothing to do with the loan. It is simply about data security. When most people apply for a loan, they are desperate and give out a considerable amount of personal information without a second thought. Most consumers often do not know what the data is being used for or how it will be stored. Another red flag that ought to worry us given the misuse we have already seen. So tonight, the government owes us a debt of protection from this shame. The digital lenders owe us a debt of basic good manners and allow us to owe each other a debt vigilance. Because in the end, debts are good when they're paid and they're used for a noble cause. That is my memo.